Yes, thank you to Paul and to Jonathan and both chambers for having us back this year to talk to you about personal tax. We have a little bit more time because we don't have coffees and things, so I thought I would start with just a recap of some things. Dan, can you move to the next slide? I can't control them at the moment. Thank you. So I thought I would start with a bit of a back to basics, a bit of a recap on Luxembourg taxation. We'll go through things that have happened in 2020 and some trends we're seeing in the Luxembourg side, COVID-19 and how it's going to impact a lot of people and their personal taxes. And then just because of the two chambers that are here today, we do some quick UK, US tax updates, which people tend to find interesting. It's a little bit different as well. Dan, do you want to put the agenda on full screen? Do you want to put the PowerPoint on the full screen? I think it would be better. If we put the PowerPoint down. Or can you let me, that's better. Perfect. And can you let me control?
I had passed it on to you, but okay, let me.
No, it just says viewing. Otherwise, I'll ask you to change. Okay, so just flip to the next one.
Okay.
Oh, it's working, hopefully. Perfect. Let's see if it will work. Okay. So one of the first things that you have to look at when you are thinking about your Luxembourg tax position is residency, okay? And it's really important for residency purposes to understand your resident status because it impacts what you actually pay tax on and what you have to report in Luxembourg. Okay. Residents, when you are a Luxembourg resident taxpayer, you have to report your worldwide income in Luxembourg. This is the starting point. A lot of people we find think that because an income is taxed in another country, they don't have to report it in Luxembourg. And this is not correct. A Luxembourg resident must report worldwide income. And I'm going to come back to that a bit later on. Non-residents have a different starting point. Non-residents are taxed only on Luxembourg-sourced income. So this could be income from a Luxembourg employer, or it could be someone who doesn't live in Luxembourg but has a rental property here. That's the starting point for Luxembourg taxation for a non-resident taxpayer. There is, however, in certain circumstances, the possibility to elect to be treated as a resident. And we see a lot of cross-border workers doing this because it gives them access to additional deductions, so can reduce the Luxembourg taxes. A couple of important points to note for people who do make this election. If they make an election for a tax resident treatment, they then have to report their worldwide income, the same as resident taxpayers. So it can be interesting in some cases to do it, but in other words, it could actually, in other terms, it could actually lead to a higher taxation. So it's case by case whether it's worthwhile doing or not. Part-year residents, these are typically people who've moved into or out of Luxembourg during the year. And they can end up filing 2 tax returns in some cases actually, or quite often, again, we see them making an election to be treated as residents for the full year because this gives them the better tax answer. So residency is the starting point. It's step 1 in working out your Luxembourg tax position. The next thing you have to look at for Luxembourg is joint taxation. Some countries don't offer joint taxation, some countries do. Luxembourg made things a little more interesting / complicated a few years ago where they gave people options. So it's important to understand A, the default position, and B, what elections are possible for you to make. So for married resident taxpayers, the default position is a joint filing. However, it is possible to elect for an individual taxation. If spouses wanted to do that, then they have to make a joint election. It must be made by both spouses, and it must be made by the 31st of March following the end of the tax year. Now, in practice, I would say in 95% of cases, an individual taxation is not going to give a lower tax answer. There's always exceptions to the rule, but in most cases, a joint filing will give the overall lower tax answer. And where we're seeing people elect for individual taxation in practice, it's normally in cases of separation or upcoming divorce. People choose not to file together anymore. For non-resident taxpayers, the default starting point is different. The default is a separate filing for non-resident married couples, but they can, when they meet certain conditions, elect for joint taxation and treatment as resident taxpayers. Again, I say, if they do this, it's not always beneficial. You need to look at the numbers, the different types of income, the specific situation, and generally, if they have a lot of non-Luxembourg sourced income, it's not going to be beneficial, but the election is possible. Registered partners, this is another interesting group that have, again, a different treatment. Registered partners, each partner is considered as a single taxpayer during the course of the year. However, they can, if they have had the partnership registered throughout the year and are tax resident at the same address throughout the year, they can make an election via a tax return at the year end to file jointly, and this can give a lower taxation. So you can see you start with residency, you start with are you filing together or separately, and this forms the basis of what you then start to put on your Luxembourg tax return. The next important thing to understand is tax class. Okay, and we'll start with the simplest situation. Single taxpayers are generally subject to tax under tax class 1. Okay, this is a tax class applied to single taxpayers. They are entitled to tax class 1A if they are single with children at charge. As I said, registered partners treated as single during the year, but if they make the election on the tax return, they have tax class 2 applied to the joint income. It becomes more complicated again when we start looking at the married taxpayers. Married resident taxpayers are subject to tax class 2 as default because their default filing position is a joint filing. Where both spouses are working, they're issued with a primary and a secondary tax card. So the first spouse will have the primary card, the second spouse will have the secondary tax card with a 15% flat rate withholding applied. Where a married couple does elect for individual taxation, each taxpayer will receive tax class 1. Non-residents, as we said, they're treated as single as default, so they would have class 1. But if they do elect for a joint taxation, they have different tax cards to the resident married couples. For non-residents, they get a calculation of a blended tax rate. The tax office look at all the income that they've submitted, they come up with an average tax rate, and this average tax rate is actually applied to both spouses. So it's different to the married and the non-married, resident and non-resident married couples will have different tax rates applied on their tax cards. So it's important to understand how those work as well when you're thinking of your taxes. From a practical perspective, there are 2 types of tax forms in Luxembourg. The Form 100 is the main tax return, and it is the one that has to be filed. Go back. There's a delay with the slides. So the Form 100 is the main tax return. This is the one that most people have to file. If anybody elects for a non-default filing position, so filing individually as married residents, filing jointly as non-residents, PACs, the registered partners, anybody who elects for a non-default filing position has to do the Form 100. You also have to do the Form 100 if your income exceeds certain thresholds, and some of the main ones are shown on the slides. The one that is commonly known is the 100,000. If you have 100,000 of income, you have to file a tax return. But it is important to understand that there are many other criteria that can force you into tax return and mandatory tax return filings. One of the ones that catches a lot of people is if they have foreign income. So foreign income is not subject to Luxembourg withholding tax. And if you have a foreign income, more than 600 euros, which isn't that high, then you have to do a mandatory tax return. The reason being, you have to disclose your worldwide income. For those people who don't meet any of the conditions for the Form 100, there is a second option, which is the Form 163. The 163 is a simplified or voluntary filing. It's a much more streamlined down version of the Form 100, and it's only really looking at employment income. You file the 163 to claim deductions. And with the 163, you can only get a refund. You can't owe more tax by doing a 163. In most cases, people have to file, report worldwide income unless they've spent the bulk of the time or the bulk of their income comes from Luxembourg. The one anomaly in all of this, which I have to deal with quite a lot actually in practice, is non-resident taxpayers who have what the tax office call a non-continuous occupation may have to file a Form 163 even though their income is more than the 100,000. The tax office deem a non-continuous occupation to be, for example, if you have, if you live in London and you commute to Luxembourg Monday to Thursday, but you work from home on a Friday. They deem this to be a non-continuous occupation in Luxembourg, even though you have a continuous employment contract. So these people, they may have 200, 300,000 of income, but they're filing the 163, not the Form 100. It's a complete anomaly within the system in many cases. In Luxembourg, you have 8 categories of income. I'll just try and get it to move to the next slide. There we go. There's 8 categories of income, and your income that you report is reported in one of these categories. So you start by reporting the gross income per category. Then you deduct specific expenses relating to that category. So for example, on a rental property, you would report the gross rent and then the management fees or the mortgage interest and expenses relating to the rental. The other category is interesting. This is where you report capital gains. Once you get to your net income per category, you add all of those together and you move on to deduct special expenses. The main special expenses are listed on the screen. I'm not going to go through them all in one by one, just because of the time we have today, and they're commonly available on the internet. You can find out more about each kind of one. I will pull out a couple. If you want to claim mortgage interest, then you must file a Form 100. You can't do this on the 163. The other deductions you can pretty much claim on both of the tax forms. Childcare housekeeping, there is a slight change to this for 2020, which we'll come on to. And the sustainable transport, the e-bike and car, it looks like this is going to disappear from 2021, but these are the current things that you can deduct from your tax returns in Luxembourg in 2020. So for those of you who haven't filed yet this year, these are the things you need to be looking at to reduce your taxes. In terms of deadlines, the Form 100, the official deadline is the 31st of March. The tax office don't generally penalise for late filing, and the majority of people do not file by this date. You receive reminders in late September that says, please submit within 30 days, and it's got a scary 25,000 euro penalty listed on it as a potential penalty. So a lot of people panic at this letter. There's a second reminder issued in late November, and this is the one where you have to start really paying attention, because this is the one where actual penalties start to come into play. Typically 800 per return, so 400 for joint filers per spouse or 800 for a single filer. And it's for a return not filed by the 31st of December. 31st of December is the deadline you really need to be focused on, because if you file after this date, the tax office have the right to revoke your refund. So if you file late and you're due a nice sizable refund, there is a high chance that you will not receive it. The 163 is slightly different. It has one deadline, end of December, and there is no late filing. So if you would have to file the 163 and you file it late, you lose your refund. They will not process your file. Once you file your tax return, you get your tax assessment. Generally, it can vary. 6 to 18 months is what the current time frame is a reasonable average. There was an article in the Essentiel, I think, on Friday that said this year they're really behind. So there's a lot of outstanding files at the tax office not yet been processed. But 6 months is certainly, you know, it would be good turnaround in many cases. And the tax office have 5 years to issue it. So it can be a really long lead time, which is fine when you owe them some money, but less fine when you're expecting some money back. We also have problems in practice because where we have, for example, US taxpayers and we want to claim a foreign tax credit, we don't have the foreign tax paid to be able to claim the right credit in the US. And here you have a 2-year time frame, so not receiving it from Luxembourg in 5 years can be really problematic in practice. That was a pretty high level sort of summary of what you need to think about and the real basics of the Luxembourg tax system. What I wanted to move on to next was some of the things that happened in 2020 and some updates on 2020. I just try to move the slide. (2020) has been a difficult year for many, and the tax office and the governments generally in most countries have not been hugely focused on income taxes when they've had a pandemic to deal with. So in terms of in sort of local legislation, there hasn't been very much, to be honest. The big things that came into force that affect a lot of people in Luxembourg, for French residents who work in Luxembourg, obviously the new treaty came into force from January 2020. We talked a bit about that last year, but there was a new circular issued that discusses how to calculate the 29 days worked overseas. There's one circular issued in relation to how they're going to rate CO2 ratings for company cars, which might change people's company car benefits. And there was 3 circulars issues in relating to border workers teleworking during COVID-19, which again, we'll talk about a bit more in a bit. In terms of other changes that happened in year, as I said earlier, the threshold for having childcare costs or household employee is typically €450 per month. During COVID-19, the government increased this limit to 600 per month for household employees. So if you employ a cleaner inside your home, from the period from April to December 2020, you can claim a slightly higher deduction, which we'll certainly see applied to tax returns next year. The other one change that has come in that is affecting a lot of our clients where we are doing the bookkeeping or accounting in addition to the sort of the personal tax is the standard chart of accounts. For those of you who are self-employed or perhaps have an SARL or SARLS and you're managing the business through those vehicles, you have to report your income to the Luxembourg tax office on the standard chart of accounts. It's a pre-prescribed format to report the data, and it's been the same for many, many years. From 2020, it's got a new format. So those people doing accounts and things, like I say, you're going to have to change the mapping and report in a slightly different way, and that's something we're working on now for a lot of our clients. The next thing I wanted to talk about was actually a trend that we are seeing in Luxembourg, and it comes back to the very first slide that I spoke about, where I said, if you are a resident in Luxembourg, you have to declare your worldwide income. Now, we see a lot of cases where, as I said, people maybe have a rental property in Spain and they never declared it in Luxembourg because they pay tax in Spain. There's a real increased focus from the tax office in the reporting of foreign income. Now, historically, we've always had clients who've received letters from the government saying, you know, we think you've got income you haven't told us about, please can you tell us? And you're talking maybe, you know, 2 or 3 cases a year over the last few years, nothing too bad. We've probably seen 10 cases of these letters in the last 2 to 3 weeks. And it's largely because within Europe and other countries, there's an increase in exchange of information. So the tax office have a lot more details on your income, your information, and they're comparing it with what you've submitted. And if you haven't submitted the data, you will now get a question. And they will ask you to go back potentially 5 years, could be longer, and file amended returns and owe more tax. So the message here really is, if you received a letter, you're going to have to disclose the income because they probably know about it already. If you haven't received a letter and you know that you have income that hasn't been declared, you should think about making a voluntary disclosure now in advance, because generally, as is the case with most tax offices, your penalties are normally less if you come forward before they ask you. The next thing I wanted to do was look forwards a little bit. So we've done, you know, the basics of Luxembourg tax, what changed in 2020. And the next one is to look forward to the future and what's going to happen. I just wait for the slide to change. Do you want to move it forward, Dan? It's really slow from my side if I try to do it.
I don't know what you did there, but you took the slides away.
No. Let me see if I can.
Wait, you took them away.
I don't know how to do that.
Daniel, if you unshare the slides, I can share them if you want.
Okay, that's fine. If you keep going down. And then I'll just ask you to switch slides. I think it's probably going to be easier, if that's all right. So go to the next one. Okay. So a couple of weeks ago, the government issued the draft law which will come into force for 2021. These are the main changes here shown on this slide of what will they anticipate will change from 1st of January. So the big things here, the ones in the middle, numbers 4, 5, 6, I'll come on to in more detail on the next slides. But a few of the smaller changes, there's no changes to personal tax rates. For people who receive the €2,500, €5,000 state payments for COVID-19, those will be tax exempt, which is good. There's some small changes to credits. The VAT threshold for small businesses is going to be raised to 35,000 from €30,000 before you have to register for VAT. One interesting thing that will impact all employees and employers is electronic tax cards. There's a testing phase in 2021, and then it should go live from January 2022, which is tax cards will no longer be issued in paper for the individual to give to their employer. They will now be available on a portal that the employer has to check directly every month for changes. They will no longer just be annual as well. They will potentially be open-ended. So somebody who has class 2 will have class 2 open-ended until something in their situation changes. So I think this will be quite welcomed by payroll. The other big change is that the commonly known as a warrant scheme, the warrant scheme will end from January 2021, and it's going to be replaced in kind by an employee profit participation, which we can cover. Do you want to go to the next slide, please, Dan? Employee profit participation is if a company in Luxembourg has made a profit, then they are able to distribute up to 5% of that profit to their employees the following year. There are certain conditions, they have to keep accounts, it's only local profit, not international group profit, and they will have to do some reporting. All of those sort of smaller details will come into play as the law goes from draft to final. For the employee who receives the profit participation, then the maximum they can receive is 25% of effectively base salary, because the calculation excludes benefit in kinds, bonuses, things like that. But when they do receive this profit participation, it will be exempt from personal tax up to 50%. So effectively, if they receive a 20,000 participation, there will be a 10,000 exemption, and the remaining 10,000 would be subject to income tax as normal. So how this will work out in practice, which employees will benefit, employers putting these plans in place, we may need to see, but this has effectively been put into place to replace the warrant scheme that will be abolished from January. Can you do the next slide, please, Dan? The impact tax regime, this has been around for a number of years now. And it's gone through a few changes in its time. It's sort of streamlined in general, and the same is happening again from 2021. Some of the smaller conditions for companies are going to be repealed, so they won't be necessary anymore. The bigger changes are that the base salary in order to qualify for the regime is going to be increased to 100,000, but the regime will be able to apply for 8 years, so it increased from 5 years. Within the existing regime, you could pay your expats coming to Luxembourg a cost of living allowance. This is going to be removed and replaced by an expatriate premium, which should be a lot easier to manage and calculate, actually. The premium can be a maximum of 30% of salary, and a bit like the profit participation we just spoke about, there'll be a 50% deduction and the tax will be charged on the remainder of the premium. Next, please, Dan. The final big change that came in from the draft law was regarding rental real estate. Currently, if you have a rental property in Luxembourg, so say you buy a new building and it's put into place, rented to tenants, then you can claim an accelerated depreciation for the first 6 years at the rate of 6% of the acquisition price of the building, excluding land. Going forwards from January 2021, any new buildings put into place from next year, the accelerated depreciation will be reduced to 4% for the first 5 years. So it makes a difference to people who are, have a lot of rental properties and, landlords in general. The 6% depreciation rate will still exist, but it will only be for renovations that have been energy efficient, so sustainable energy. And if these renovations are made on a property older than 10 years, then the 6% depreciation and a reduced VAT can apply for the first on the renovation costs themselves, and then on those costs can be depreciated at the higher rate for the first 10 years. There's a third point that has been introduced, which is also a real estate deduction. And this one is a little interesting. It makes the whole thing a little bit more complicated. I think it could have been slightly easier, but for property that is subject to the new 4% reduced rate. So this is new buildings put into place as rental real estate. They can actually get an additional 1% depreciation, so from 4 up till 5. But there are conditions to this calculation. The 1% is capped at 10,000, so really is only applying to property up to 1 million. And the other thing you have to consider with this is if you have multiple properties, the 1% is applied to the total acquisition price, not the price per property. So for landlords with multiple properties, you'll probably find they're less likely to, well, it would likely be capped at the 10,000, I would imagine. Okay, next slide, please, Dan. In terms of COVID-19, 2020 is going to be a really interesting world in personal tax. It started with people being, from March, people stuck in a country where they don't normally live or work. They might have chosen to move to another country during lockdown to look after relatives. They might have been forced to telework or chosen to telework. So there is a whole change in people's normal working pattern, and it's going to play a big impact on their individual taxation. Can you go to the next slide, please, Dan? Looking at the Luxembourg demographics, I think the cross-border workers are the first set of people to look at in terms of COVID-19. So typically, if you are a Belgian resident, for example, then as long as you're coming to Luxembourg and you're working for your Luxembourg employer in Luxembourg, you pay your tax in Luxembourg. Each of the treaties with the border countries has a prescribed number of days when you can work outside of Luxembourg. If you exceed those days, your income is taxed in your country of residence as opposed to in Luxembourg. So when COVID-19 hit and lockdowns hit and all the cross-border workers, or a high proportion of them, were required to work from home, they're obviously going to exceed these prescribed number of days that are listed in each treaty. So what Luxembourg did is they agreed new provisions with the border countries to say, look, because of this special situation, they agreed that the income that's earned from working from home due to COVID-19 will be taxable in Luxembourg and not in the normal country of residence. There were a couple of iterations with the current state of play that the residents of these countries, if they are teleworking through to the end of December, then the income will be taxed in Luxembourg and not in their country of residence. What happens in 2021, obviously we don't know yet. We know that France weren't totally happy with the situation because they'd like to tax French residents working in France. So I think depending how the pandemic continues, we have to see how this changes into 2021. Social security for these populations of people as well. Normally, if you are resident in a different country to the one where you normally work, you pay social security in the country where you work, unless you work more than 25% in your country of residency, in which case you should pay social security in your country of residency. So again, with teleworking, you have a lot of people in COVID-19 who are going to be way over the 25%. The EU issued basically a blanket approach that said for 2020, we ignore the 25%, leave your social security where, affiliation where it is. So for the border workers, I think COVID-19, certainly through this calendar year, it's okay. It's quite clear what will happen. The more interesting or more unknown is what happens to people who are in another country. Can you go to the next slide, please, Sam? I'm going to use the UK as an example here because I have quite a few people in this situation. If you're somebody who normally works in Luxembourg and has their income taxed in Luxembourg, but you were locked down in the UK, you don't benefit from the same provisions under these teleworking agreements from France, Belgium, Germany. Your income from days worked in the UK is going to be taxed in the UK. And HMRC have issued guidance that's quite strong, actually, that they're going to tax these populations of people. And they've got different rules for, will the days count for residence purposes? Will they count just for taxation purposes? Can they be exceptional days? Exceptional days, they've indicated that if you could leave after the exceptional period and you didn't, then it's not an exceptional day. So you had to leave the UK as soon as you could. So, you know, what does it actually mean in practice? You know, will there be a higher tax to pay because you worked in another country? Does the employer have an obligation? If you're in the UK, then should your Luxembourg employer be reducing the amount of tax they take from you on the payroll? Does the company have a payroll obligation in another country? Some countries require a company with an employee in that location to run a shadow payroll or some form of payroll. And our employers are aware of this. As an individual, you know, if you've had withholding tax or paid tax through salary on all your income, and now you're going to have to pay it to another country, what if you haven't had it back from Luxembourg yet? Yeah, or you have to pay in Luxembourg and you haven't had it back from somewhere else. And the mismatch in treatment, you know, different countries, different rules, different treatment of all of this working patterns, I think is going to make 2020 tax filings quite interesting as we see practically how tax authorities are going to deal with these situations. Going forwards, I think it's going to be really, really interesting to see how tax law changes and evolves, because I can foresee that, you know, teleworking is going to be more common in the immediate future, if not in the long term. So how does tax law change to, you know, to facilitate these kind of arrangements? You can go to the next slide. Other way. One question that we've been asked by quite a few of our clients is, for those who have been working from home, can they deduct anything? Is there anything they can deduct on their tax return as a result of working from home? Now, for employees, each employee benefits from a deduction of €540 for unreimbursed business expenses. And for many, this might cover the additional utilities or whatever is the cost of working from home from time to time. However, if you've had to maybe buy a desk, buy a chair, buy additional equipment, your employer hasn't reimbursed it, there's also a potential to claim a portion of your rent and utilities for this space you now use as an office. I think that I can certainly see these claims going in 2020 on tax returns. What remains to be seen is how amenable the tax office and how willing they will be to accept these kind of claims. And that obviously remains an unknown. For people who own a property, there's a potential for mortgage interest or to claim a portion of it as relating to the business. I'm a little more reluctant to do it when you own your property, only because I can foresee a situation where you claim that effectively a portion of your main residence is a business premises that you use for business, claim a tax deduction. So then if you were to sell it in the future, would the tax office look to tax a capital gain on the portion of your home that was actually a business premises? It's a grey area, it's a question. I don't have the answer, but it makes me a little more reluctant to claim sometimes when you own your own house. You can go on slide 10. Okay, we're getting towards the close. I just wanted to give some UK and US tax updates because we're the British Chamber, the American Chamber. It's always interesting to know what's going on in these locations as well. So you can go to the next slide, please, Sam. For the UK, obviously the big unknown remains Brexit. Whilst from a personal tax perspective, we have the double tax treaty between the UK and Luxembourg, and it stays in place. So for the incomes that are subject to, you know, double tax treaty provisions, that's still quite clear. It's not going to change. Where there is an unknown at the moment is social security. Currently, the UK falls under the EU legislation, and there is no social security agreement yet with the EU or with the individual countries. So if there's a potential no deal, leave the UK, there is a potential for a double social security obligations for Brits working in Europe, or if there's people from Europe who go and spend some time working in the UK. And that remains an unknown. And other points in the UK that probably, I've just pulled out the ones that probably most affect people here in Luxembourg. Over the last few years, the UK have sought to phase out the ability to deduct mortgage interest from rental income. From April 2020, it's gone. You can no longer deduct any mortgage interest from the rental income. There's potentially some tax relief available, but you can't deduct it as an expense. The UK is always focused on disclosure, foreign income, any undeclared income, any kind of tax avoidance, tax schemes to save tax. So all of those require disclosure. And from April 2020, there was the obligation on any sale of any UK real estate. You have to file a specific capital gains tax return and make an advance payment of capital gains tax within 30 days of the sale. So this is relatively new as well. It's been around for non-residents for a little while, but it's now applies to anyone selling UK real estate. Can you do the next slide, please, Dan? For 2020, there in the US, there was a few changes to the treatment of IRAs. The biggest one I think I've pulled out here, which is that historically when a US taxpayer would inherit an individual retirement account, they were able to have the amounts in the account distributed over a long period of time. That's now going to be reduced to within 10 years. So it has to be fully distributed in 10 years, which for some people, it could really result in an increased income over that period, because there can be significant amounts in some of these inherited plans. The stimulus payments that were issued by check for COVID-19, people got them, people didn't get them, people who should have got them, shouldn't got them. All of those, essentially the stimulus payment is a special tax credit for 2020, and the checks were issued to give the individual taxpayers that tax credit in advance. So if you didn't get your check and you were entitled to a check, it will be reconciled on the 2020 tax return using this special tax credit. The other big tax change that came in was in relation to GILTI. And GILTI doesn't affect everybody, but for those it does, it's a really big change. GILTI was introduced in 2018, and it basically taxes an individual shareholder on profit in a foreign corporation that has not yet been distributed to that shareholder. Since it came in 2018, we've had success in a couple of elections to reduce the tax as a result of the GILTI legislation. But high tax exemption is a new one that came in the middle of 2020. And it requires a little bit less reporting. It's a little bit less complex. So it's a really welcome change for the people who are subject to this GILTI legislation. Looking forwards, I guess that the next piece was going to be, there's going to be a new president in a number of weeks, and what will he change? Looking at the tax plans that he issued, you can anticipate an increase in tax rates, limitations on deductions and things like that. And as we often see in the US, they may revert what the previous president put into place. So we can imagine that a lot of the provisions in the Tax Cuts and Jobs Act in 17 might be reversed. But again, we have to wait and see. Next slide, please. Just before we went on to questions, I thought we would just wanted to take the opportunity to give the people who sign in every year just a few updates on what we've been doing in 2020. It's been a big year for us here at Analie. After 2 years of construction, we finally moved into our new offices in Gondorange. So post-pandemic, we hope to invite people into our new buildings rather than just seeing them on Zoom. Our US office in Houston is due to open in the coming weeks, so it should go live for the 2020 tax filing season. And the last point is we're hiring. So if there's anyone in Luxembourg who'd be interested in working in this kind of environment or has been interested in what we've said today, then please get in touch. That's it from me.